It's Thursday, July the 7th. Let's talk about something that everybody wants to talk about, the Fed funds minute. Isn't that exciting?
That was exciting. It really was. And it's what, in that exciting exchange, it is interesting enough, and it is a microcosm in the bigger picture. So don't go out and make decisions on what we're going to say, but we'll explain something to you. In the last 3 days, the stock market's been up.
Yay.
And the reason it is because the Fed's minutes and indication in the minutes that the Fed turned the light switch on and said, hey, we got inflation and we got to get serious about it.
Yeah.
And that
Duh.
the 75 basis point was warranted. We might probably going to have to do it again. And then in quotation, air quotes, hey, if we need to slow this economy down to get hold of inflation, by golly, we're going to do it. Now, we're tongue in cheek with you on this, but the reality of it is, and the upside to it is maybe the Fed have gotten serious about this and getting hold of inflation is they've indicated to the markets they're going to do it.
I think it also indicates we're nearer the end of this worst half of the year in the last 50 years. We're nearer the end than the beginning. And so I think we still expect to see another downdraft. There's so many bad headlines that could be written and so many things that could occur that would be negative to the markets, but we're closer to capitulation than we were 2 weeks ago.
And you said this last week, you said it in meetings when we've been in meetings with clients, that you hope we go on and get in a recession. This week, you and I commented, there's several Fed regional folks that are saying that they believe the second quarter GDP will indicate a negative GDP. So first quarter was negative 1.6%. If second quarter, and you said this morning,
the Atlanta Fed is
Right.
negative 2.1% anticipated.
So July 26th, 27th, we'll know that. And quite frankly, in not a negative gross way, we would like it to occur. But in doing so, we technically have, quote, a recession. Now, you and I also talk, how can you have a recession when you only have 3.6% unemployment? That's a head scratcher. But you observe that the reason is because in the pandemic, people just dropped out of the work. So those numbers that are being used to calculate it truly aren't the correct numbers, in our opinion, to do.
People that were between 60, 65, or even a little older said, I just don't need this anymore. I've got enough money saved, or I'll re-enter the workforce in, a year or so in doing something totally different. And also what's not counted in those numbers are new startup businesses. So those numbers are going to be counted at some point, probably later this year, people who started businesses. So the head counting is not on cue right now.
There's still a lot of cash in the portfolio. We recognize that. We know that. We are waiting for one more Fed meeting. It's a promised 75 basis points increase. We're going to look then at the bonds one more time. The majority of the bonds are 2023 maturity, 2024 at the most. We believe we'll get even higher than the 4% that we are getting. If we can, some of that cash probably would get reallocated to carry us through this year into the first of next year.
We want to keep some dry powder.
But then we're going to keep the half of it or better part of it in dry powder because, folks, we got the buy list that we want to buy. We know what we want to buy, and we're positioned correctly. And we're going to come out of this on the backside in the recovery. We're going to get where you need to be. So we got a game plan. We got choppy waters. We got summertime. Go to the beach. Enjoy outside. Put sunscreen on.
Summer's always bad for markets anyway,
Right.
So we don't anticipate anything better. We do expect to see some life in markets later this year as we get closer and closer to the midterms.
So get through the summer. Get into the fall. Always remember, it is your money.
And your money matters.
We're here for you.